Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Friends, in this video for ithought Advisor, we are going to speak on the topic getting the equity debt investment mix right. Traditionally, investors have always been biased towards one asset class. The traditional investor always was heavily leaning towards debt. Within debt, his inclinations were clearly favoring bank deposits. They wouldn't even move from a bank deposit to a company deposit or a bond or a debt mutual fund. These things were seen as more volatile than a bank fixed deposit. So they preferred the bank fixed deposit. This was how investors made choices during those years of high interest rates. But when interest rates kept falling and went to levels where they barely beat inflation, investors were forced to think of alternatives to once again improve their returns. Their asset allocation changed and equity started coming in. But this change in asset allocation was not something because of conviction growing in equities. It's purely because they saw prospects diminishing in debt. And over time, as interest rates kept remaining low or not rising fast enough, investors moved more and more towards equity because equity started showing performance where debt was not showing performance. So money started chasing performance. So the asset allocation which changed was not because of conviction in equities, but because performance was being sought after. As equity preferences kept growing, many investors who are traditional debt investors became predominant equity investors. This is something even they would not have imagined. And returns continued to be decent. With every passing market cycle, investors moved more towards equity than in the previous cycle. In the current cycle, investors have moved away from debt to an extent which is quite remarkable. People have preferred equity. People have made equity their preferred asset choice when traditionally it used to be debt. So this shift is largely driven by the low returns which debt has been historically giving. But all this can change. From the prevailing interest rates, if interest rates go down, some debt investing could be very helpful, and it would be helpful in more ways than one. If you are a bank FD investor, it will help you lock in into the current rates. If you are a mutual fund investor in debt, it will give you more gains from falling interest rates in the future. If you are a bond investor, you can lock into higher returns from your bonds for the next several years. So these are options which investors are not considering enough. This is a time when investors must think how they can reset their debt equity mix and actually give more exposure to debt. Because most people today have decent equity exposure and they have little or no debt exposure. So there is a significant headroom to build debt exposure. Investors don't seem to be even looking towards debt opportunities. This is not unusual. Whenever returns are very good in one asset class, money tends to gravitate towards that asset class and get over allocated to it, while the asset class which is out of favor tends to get ignored so badly that investors have little or no allocation or inadequate allocation in that asset class. Debt is probably at that place and it needs to revert back. And when interest rates fall from where they are today, that reversion may actually gain further speed. So as an investor, you must decide how to periodically review your equity debt risk and balance and try and scale up your debt portfolio over the next 1 year or 2 years. When equity valuations are high, doing this shift towards debt investing will ensure that your debt portfolio gets built, and when equity valuations soften, debt valuations may actually move up when interest rates come down. So, these are all the opportunities before us. These are our priorities which we should not forget, and these are actions which should be taken in a timely manner. I hope every one of you understands the gravity of the situation and acts sensibly before interest rates start falling in India. Thank you for watching this video.